Hey friends, in today's video I'm going to share my Scalable Capital portfolio with you, how I use this platform and the things that you should be careful about as a beginner in Germany. So to sign up with Scalable Capital, just go to the first link in the description below. The sign up process is quite easy and it can take just a couple of minutes to register with Scalable Capital. Scalable Capital has a web app as well as a mobile app. In today's video, I'm going to share everything using their web app. Once you log into the Scalable Capital app, this is the web interface that you're going to find. The first option is the free broker, then you can add additional products, but that is outside the scope of this video. So once we click and see the portfolio details, here I have all of my investments. I'll share all of these later on in this video. However, there's a new feature from Scalable Capital, that is Insights, where you can monitor your portfolio health, the different sectors, the allocation. But this is just available in the Prime option for Scalable Capital and not in the free one. So if you're interested in getting an in-depth analysis of your portfolio, you can sign up using the first link in the description. In Scalable Capital, I have invested in 8 individual companies and 1 ETF. The ETF that I have invested in is the S&P 500 Information Technology sector. This ETF invests in the information technology companies that are within the S&P 500 index. To get more information about this S&P 500 companies, let's have a look at the official document from iShares to have a detailed look on which companies this ETF is investing in. So a large majority of this ETF includes Apple, Microsoft, Nvidia, Broadcom, Adobe, Cisco, Salesforce, Accenture, Oracle, AMD, and many other companies. You can have a detailed look in the official website. I'll put a link to that in the description as well. Whenever it comes to ETFs, the most important aspect or the most important point while selecting an ETF is the total expense ratio. So for this ETF, the total expense ratio is 0.15% per annum. This is the fee that is cut automatically whenever you are investing using a specific ETF. This ETF is not the cheapest one out there, as it has 0.15% total expense ratio. The cheaper ones are between 0.04 or 0.07% of total expense ratio, but I've seen many ETFs that are in the high 0.5, 0.75% or even more than 1% in terms of cost. So whenever you're selecting an ETF, please be careful about this cost and keep this cost as little as possible, because if there is a high total expense ratio, this can cut into your profits in the long term. Let's have a quick calculation on how having a high total expense ratio can cut into your profits. So let's look at this calculator, which is from the US government. Let's assume you have a €0 investment as an initial investment, and each month you put in €100. Let's assume a time period of 20 years where you're investing €100 every single month. As a market average, let's say the estimated return is 7%, and let's calculate it. Now, based on this calculation of €100 investing every single month, you would have €49,194 in the 20 years instead of €24,000 without the investing. So if you kept this money in the bank, you would have 24,000. However, with the investing and 7% increase, you are at 49,124. This is assuming that there is no total expense ratio. Let's assume there is an ETF which has a 0.5% total expense ratio. So our estimated return would be 6.5% instead of 7.5. On calculating that, our profit has decreased from €49,000 to €46,000. Now, this is obviously for 20 years. But let's assume someone was investing for 40 years and the return at 40 years having 6.5% return was 210,000. At 7%, it would be 239,000. So it's making a huge difference of about €30,000 in 40 years. Even though it's a small percentage, but it can cut into your profit every single time. So be sure to select an ETF which is having a lesser total expense ratio. Looking at my position, I have invested a total amount of €1,843 at 99.339 shares. The profit that I have gotten from this ETF is about 5.64% or €104.06. Many people ask me what is my favorite ETF. I usually recommend going into a broad market index fund that is tracking a huge index instead of individual stocks or very sector specific. For example, the iShares S&P 500 IT sector ETF is quite risky as it is tracking just the information technology sector. If you go and buy an ETF which has a higher number of companies, for example, the S&P 500, so this ETF would be tracking 500 of the biggest companies instead of the 70 odd companies in the IT sector. And if you want to have more diversity and less comparative risk, then you should look into the MSCI World ETF if you want exposure to the Western world, and the MSCI World Emerging Market ETF if you want exposure to the emerging markets. If you're getting value from this video, please hit the like button and consider subscribing for more. To search for ETFs, simply go in the search section and let's search for the MSCI World ETF. So when I search the MSCI World, we get 137 results. Now each of them is different from the other. For example, the first ETF that we have is from Invesco. The second one we have is from iShares, then Xtrackers. Now these are different companies that provide ETFs. So on the right hand side, you can also see the difference in their prices. The first one is 79.7 euros, the second one is 55.4, and the third one is 81.23. Generally, these companies track the index itself. However, there are certain changes. For example, if you look into the Invesco MSCI World, it is managed by obviously Invesco. The total expense ratio is 0.19% per annum. Then the replication is synthetic. If we go back and have a look at the iShares MSCI World ETF, now this one is having a total expense ratio of 0.5% per annum. The distribution is distributing and the replication method is physical. I have discussed the replication method, the total expense ratio, and the distribution policy in detail in this video. Similarly with Xtrackers, the total expense ratio is 0.19%, the distributing policy is accumulating, and the replication method is physical. Now, as you've seen, all three of these ETFs are tracking the MSCI World ETF or the MSCI World Index, but the main difference that we see here is the 0.19% per annum fees for the Xtrackers and the 0.5% of fees or the total expense ratio from the MSCI World ETF from iShares. Now this is one of the biggest differences. Another difference could be the accumulating and distributing. So always look for the information or always look at the details of the ETFs that you are investing in. Let's go back and have a look at the individual stocks that I have invested in. The first one is ExxonMobil. I have a total profit of 1.64% with this stock. With IBM, I have 5.32%. Caterpillar is at 1.37%. With Procter & Gamble, I have 1.08%. With Microsoft, it is 11.64% profit. With AbbVie, I have a loss of 7.36% or 39%. With Medtronic, I have a loss of 18.62%. And with Neo Performance Materials, I have 61.55%. Now, all of this profit is not realized and neither is the loss. So what I mean by realizing a loss is, at this moment, I have invested almost 1,000 euros in ExxonMobil and the unrealized profit is 15.33 euros. I can only realize this profit when I sell this stock. So if it is not sold, if I've kept my position, any losses or any gains that I have with this stock or ETF will be either unrealized gains or unrealized losses. Anytime when I realize my gains or realize my losses, taxes would be involved. So let's assume if someone has 100% increase or 100% unrealized profit, they would not have to pay any taxes until and unless they sell their position and that profit is realized. So I get many questions from beginners. How would taxes be handled if they do not sell any position? So there would be no taxes involved if they do not sell their position. Similarly with losses, you would not be able to adjust your losses against any gains if you do not realize your losses. So what should you be careful as a beginner who is just starting with investing? So as a beginner, I would always recommend that you look into ETFs first and then After you have gotten some experience in ETFs, only then should you start looking into individual stocks. In this video, I share how I invest in individual stocks. So thanks for watching Black Wizard, and I'll see you in this video.